Good morning, good afternoon, good evening, folks. How you doing today? Michael Zuber, one rental at a time, back with my good friend and legendary investor, Jonathan Twomley. How you doing, sir?
On fading in and out of this conversation. I'm doing great.
Yeah, our joint internet providers are terrible, but we are doing the best we can. So, Jonathan, I don't know if you saw this, but I did, and it looks like Citigroup has raised their expectation for the 10-year note to 2% at the end of the year. For those of you that don't watch it as closely as I do, it's currently trading at 1.2%. So that's about a 40% move. And the reason I wanted to talk to you about this is you are in the multifamily space. You do big deals, multi-millions of dollars, tens of millions of dollars. And I'm guessing a 2% 10-year note would impact a lot of stuff in multifamily that people don't normally think about. So, Jonathan, the 10-year note's now 2%. What do you think happened in multifamily? What's the ripple impact?
Yeah, so this will kind of play out in a couple of different ways. So one thing that might happen initially is that so the thing you have to understand is the interest rate that you pay as an investor includes the base rate of whatever the treasury is trading at, plus a spread over the treasury, which is basically the bank's markup on the money it's lending you, because it's borrowing money from the Fed and it's then lending the money to you at a markup. Mm-hmm. So their profit is in that spread, and the spreads can go up and down depending on the more confident the banks feel, the lower the spread, the better credit you have. So the issue really then will that increase in their spread by taking lower profits because they think that, well, this is such a great secure asset that we feel very secure, so we don't need as much of a risk premium here, or if the lenders are going to pass it through to investors. And you could potentially, both of those things could happen depending on who the borrower is, right? So, and what the product is, and like what the loan program is. I mean, there are a lot of factors that go into this, but let's just assume that this is all things are equal. You know, the bank wants to make the same amount of money on its lending, right? And it's gonna pass this increase on to investors, generally speaking, right? So what is going to happen as a result of that? Well, the way that this works is when the amount of interest you pay is going to impact your basically the amount of money you have to pay the bank each month, right? Mm-hmm. And the banks are looking for you to, as a multifamily owner, not just to pay back the loan, but they're looking for you to make enough money that you have a cushion above your loan payments that makes them feel comfortable that you're really going to pay back the loan, right? And that cushion is 25% more than the loan payment. So in order to get the loan in the first place, you must have what's called a debt service coverage ratio of 1.25x. That means your net operating income after all your operating expenses must be 125% of your loan payment, or the bank is not going to give you the loan. If your interest rate goes up, that increases is the amount of money that, right? So rates rising to everybody. One is that the banks will say, we accept your valuation of the property, but we're just not going to give you as much money because we need to keep your debt service below that ratio, right? So they're going to say, well, you know what? We would have given you 75% before, but at this price, we can only give you 67%. And now you've got to go come up with the additional equity. Of course, when you come up with more equity, it reduces your returns to your investors, to equity, right? So because everyone gets diluted. So your leverage goes down, your profits go down. So that's one thing that could happen. Or the banks could say, and so that's what will happen. I mean, that's the first thing that's going to happen. Then the knock-on effect of that will be that so borrowers will start going to sellers and saying, we can't get the proceeds that we want. We need a haircut on the property price, right? And so that process will take so you'll see, but eventually it will translate into to higher cap rates, right? Now, borrowers who are more sophisticated may try to essentially make up the leverage by layering in preferred equity, which is equity with some debt like qualities to it. It sort of acts like more leverage, but the preferred equity can't foreclose on the property, so it's not really debt, but it sort of acts like debt. They'll do some financial engineering to try to get the returns to the common equity that they were shooting for originally. But eventually what will happen is that interest rates at some point, they'll start pushing cap rates up because people just won't be able to square the circle. They just won't be able to get the return that they need. And they're just not going to be willing to pay as much for property. So, but I think a move like, even though you said it's 40%, it's 40% on such a low base that I don't think it's going to, if it pushes up cap rates by half a point or whatever, I mean, it's not really going to affect the market that much. The people it'll hurt the most are those who already are in contract at a certain price, and then the rates move against them. That can happen, and it's really painful because you've got to go try to retrade with the seller, and usually the seller's like, too bad. Especially these days where people are putting up hard money on day one. You don't have a whole lot of leverage, so you might just be stuck equity, or you probably will have to go raise some additional equity, I think.
The other area, Jonathan, I was thinking about here was not only the deals that are in contract yet to close, but I guess where I was most concerned was those deals that were put together the last year or two with bridge debt that need to refi, and they had some aggressive assumptions. If they're doing that into a higher rate, higher cap rate environment, might they be short on the refi and have a problem?
Yeah, can you ask it again, because I lost you along the way here?
Yeah, I'm sorry.
The question.
Yeah, basically the parties that I were concerned for were the ones coming off their bridge debt. So they already own the property, but they had a short-term, value add that then they were going to refi into permanent debt. They may have assumed a 4 cap or 4.5, and now it's a 5 or 5.5. I think those people might be in big trouble.
That could affect them if they had been really aggressive on their assumptions, and then they didn't make as much, rent increases or whatever. I mean, if they've done a really solid value add, they should have enough cushion in there that a small movement in interest rates shouldn't kill them. But they may make less money than they anticipated, right? They may get less proceeds. They may be able to refund like less of their equity, what have you. That could affect them. But I think you're probably not from that. Probably not looking at like losing the property or having your expectations really upset, but it'll definitely make it a little bit harder to refi the property, and they'll have to tamper their expectations about their profitability for sure. But yeah, and eventually but I'm assuming that this is responding to the additional pressures of inflation that the banks are seeing. And if this continues, then you're going to see interest rates rising, and that is going to be what kind of upsets the apple cart in the property markets for sure.
And again, one of the things, if you're thinking about multifamily, one of the areas to watch is the 10-year, because that's kind of that base effect, as Jonathan alluded to early on. Then they add the margin or spread for profitability. but then that affects the NOI, or it affects cap rate, then take that against the NOI. It's just all of these other inflation, cost of maintenance, taxes, insurance. Can you get the 3% rent increase you want? Lots of stuff going on into an environment where interest rates are raising. So it's time to pay attention.
Yeah, I mean, when margins are razor thin, as they are now, because the cap rates are so low, then really every little thing makes a difference. If you're buying at an 8 cap, you have a lot more room for, like, if interest rates go up a half a point, yeah, you're not happy about it, but it's not going to kill you. Whereas if you're buying at a 4 cap, it makes a big difference in terms of how much money you're going to make. So, and everything for costs go up. Low cap rates. So
very cool, Jonathan. Well, this has been a great conversation, folks. Follow the 10-year at least once a week just to see what's going on. And Jonathan, how can people be a part of your world?
Yeah, come and join me in the multifamily investment community on Facebook. Just questions that we have for new members. The group answer the questions, but after